we live in a world where the financial institutions want your money on a regular and ongoing basis. The corporations want to, through products failing, you buy the next product. Same thing with cars. The government wants to tax you either long-term, short-term capital gains or ordinary income based on how you sell your products or whether you have an IRA, 401k, or after-tax account. That's all real. What the banks don't want you to know is, hey, if you put money into a cash value life insurance policy, because it's not going to go to the bank, the cash value gives liquidity that can be accessed anytime. You borrow against the cash value without taxes or penalties, making it a flexible source of funds. So what does that mean? So if I have $100,000 sitting in a CD, or if I have a normal life insurance policy that I've designed properly up front and I overfunded by $100,000, well, guess what? That $100,000 I can leverage out while it's still earning a rate of return in the policy. Whereas the money that's in the CD, if I take any of it out, the remaining portion is going to be in the CD, not the full amount earning the rate of return. The banks don't want you to know that because this is exactly what they do with bank-owned life insurance or corporate-owned life insurance. At the end of the day, in closing and in final thoughts, it's important to understand that if we mimic what the bank does, I'm not saying don't put any money in the bank, but don't go past 250. We can mimic what the bank does, and we could also be able to put ourselves in a position to have leverage, liquidity, and control, put us in a place to where we get multiple use of each and every dollar. And that's where the magic is, not compounding a product, but compounding an overall process. Now, you often hear about become your own bank. And what does that mean? Well, become your own bank is, I'll give you a quick example with a car. If I was to buy a $50,000 car in cash, 5 years later, that car would be worth, and I'm just making this up, less, or let's say in this scenario, $25,000. If I bought that same $50,000 car and I financed it through one of the motor company's banks, it may cost me $65,000, but the car physically itself is still going to be worth $25,000. But what if you financed it through your life insurance policy, become your own bank? In other words, you borrow $50,000 out of the policy, you pay for the car, but you pay that $50,000 back over the next 5 years. Even though the car is going to be worth $25,000, you're going to recapture that interest inside the policy. The other thing that they don't want you to know is how there's less risk inside of a cash value contract. What do I mean? So if I have a brokerage account that's worth $1 million and I want to create a line of credit off it and it's all in stocks, they may give me $500,000. If it's a bond account, they may give me $600,000. If it's cash value, you get the full $1 million. If not, $950,000 you could leverage out because of the financial stability of the mutual life insurance company. They almost leverage it out dollar for dollar. You don't have to worry about a discount because of the risk of a stock or the risk of a bond. That's where the real power lies. Also, the tax benefits. What do I mean by that? So if you fund the cash value life insurance policy over the years, even if it's with after-tax dollars, but then you get on the distribution side, if you get on the distribution side up to basis, which is the money you put out, and then after basis, you maintain tax-free status by borrowing, you're now having the tax benefit on the distribution side. Once again, the banks don't want you to know this because they want you to put that same money you would put in the policy inside the bank and have you buy term insurance, which in the end, term insurance expires worthless because 99% of these policies don't ever get a death benefit claim because they're either replaced or they ran out of the term of the term policy itself. So this, if you want to learn more, click the link in the bio about how to set up a cash value life insurance policy bank and start leveraging your money to invest in assets like the wealthy do. We want to go right down Rumson Road right here and tell you all of their secrets, not on tax savings, but tax strategies, not on how, like, hey, if I leverage my account in the stock market, but how do I leverage my policy and really be able to get multiple use of each and every dollar. This is about being educated. This is about understanding, money in, money out, product in, product out, advantages and disadvantages, how you can overfund cash value and really be able to live the life that you deserve because financial freedom can be yours. Click the link in the description to learn more about how to set up not only a cash value life insurance bank and start leveraging your money to invest as the wealthy do, but we also want to also point out that the wealthy understand tax strategies, not necessarily just tax write-offs. The wealthy understand how to buy businesses without coming out of their pocket. The wealthy understand how to create generational wealth through these banks, and we want to teach you that. So go ahead and do that link. Sit down with one of the people here at Epic. They'll take you through the success process and be able to show you exactly what to do based on your goals and objectives.